Most financial advisors will tell you to invest your extra money instead of paying off your mortgage early. And in some cases, they're right. But what they don't tell you is that blindly following that advice could cost you hundreds of thousands of dollars, depending on one single number. That number is your mortgage interest rate. And once the math is laid out clearly, the always invest crowd might not have as strong a case as they think. In this video, we're breaking down exactly how mortgages work, when investing wins, when paying off your home wins, and the strategies to pay it off faster, if that's the route that makes the most sense for your situation. How mortgages actually work. At a really basic level, when someone gets a mortgage, they're buying a home with borrowed money from a bank. And they must pay back the sum borrowed with interest over time. That's how banks make money. So let's say $400,000 is borrowed to buy a house. On a standard 30-year fixed-rate mortgage, the bank breaks it down into monthly payments over 30 years. That's 360 payments. Each monthly payment has two components. And understanding this is vital to answering this whole question. The first component is the principal, paying back the original sum borrowed over 30 years. The second is interest, charged on whatever remaining balance hasn't been paid off yet. On a $400,000 loan over 30 years at a 7% interest rate, the interest payment is always calculated as remaining balance times 7% divided by 12 months. So in the very first month, the payment comes out to roughly $2,660. But here's the fascinating or maddening part, depending on how you look at it. Of that $2,660 payment, $2,333 goes toward interest, and only $327 goes toward actually paying down the home. This is how mortgages work. Banks front-load the interest payments because they get paid first. The result? The principal balance, the actual amount owed, barely moves until much later in the loan. In fact, in the first 20 years of a 30-year fixed-rate mortgage, interest payments still exceed principal payments on every single monthly payment. That means for the first 240 payments, the majority of every dollar is going to the bank, not toward paying off the loan. Looking at the yearly amortization schedule, at the end of year 20, there's still $229,200 owed on the house. That's 66% of the way through the mortgage in time, but only 42.75% of the original loan has been paid off. And over the full life of the loan, on a $400,000 mortgage at 7%, the total interest paid comes out to $558,500, bringing the total cost of that loan to nearly $958,000. At 5%, that interest drops to $373,000. At 3%, it's around $207,000. Still a lot, but significantly less. The takeaway here is the faster the principal balance gets reduced, the less interest gets paid overall. Stock market returns. Now let's look at what stock market returns actually look like, and whether investing beats paying off the mortgage early. The S&P 500's average annualized return since adopting 500 stocks into the index in 1957 is around 10.26%. After accounting for taxes, a reasonable ballpark is somewhere between 7 and 8%. If the mortgage interest rate is, say, 3%, like many people locked in back in 2021, making extra mortgage payments is effectively earning a 3% return on that money. But taking those same extra dollars and investing them has historically returned around 10% per year, or 7 to 8% after tax. Mathematically, investing wins by a wide margin. But when mortgage rates climb to 6 or 7%, like they have been more recently, the decision gets a lot closer. At 6%, paying off the mortgage early is a risk-free, tax-free, 6% return on every extra dollar applied to the balance. That's not easy to guarantee in the stock market, and unlike the stock market, there are no losing years when paying down debt. There's also one more variable that matters enormously: how many years are left on the mortgage, and how many years are available to invest. Here's a concrete example. Taking an extra $500 per month and investing it at an 8% return over 25 years yields over $473,000, Applying that same $500 per month toward the mortgage at 8% saves $188,000 in interest. Why such a big difference, even at the same 8% rate? It comes down to amortization versus compounding. Extra mortgage payments reduce principal faster, saving interest over time. But invested money compounds immediately, growing exponentially. These two forces don't work the same way, and over long time horizons, compounding in the market tends to win. That said, if there are only 5, 10, or 15 years left on a mortgage, the math gets a lot closer, and it's worth running the specific numbers. So here are two general rules of thumb. The lower the mortgage interest rate, the more it probably makes sense to invest. The longer the time horizon, the more it probably makes sense to invest. But these rules come purely from a financial and mathematical standpoint. Paying off a home isn't always just a financial decision. The freedom of having no mortgage payment every month can be worth more than any spreadsheet can quantify. Tips to pay off your mortgage early. So how does someone go about paying off a mortgage faster without completely straining the budget? Here are 3 strategies, and they all share one common theme: applying extra payments directly to the principal balance. Strategy 1: bi-weekly payments. Instead of making one monthly payment, split it in half and pay that amount every 2 weeks. On a $2,660 monthly payment, that's $1,330 every 2 weeks. Since there are 52 weeks in a year, this results in 26 bi-weekly payments, or the equivalent of 13 monthly payments per year. That's one extra full payment toward the principal every year. Important note: contact the lender and confirm that any extra payments beyond the normal monthly interest are applied to the principal balance, not to future interest. On a $400,000 mortgage at 7%, bi-weekly payments pay off the entire mortgage in 23 years and 11 months, saving 6 years and 1 month of payments, and over $134,000 in interest. Strategy 2: pay an extra $100 to $200 per month. Even a modest extra payment each month adds up significantly. Adding an extra $200 per month on this mortgage saves roughly 6 years of payments and $126,000 in interest. These first 2 strategies work best when the interest rate is in the 6 to 8% range. At lower rates like 2.5 to 3%, the savings are smaller, but still real. Strategy 3: apply windfalls to the principal. Whenever a tax refund, bonus check, or unexpected windfall comes in, applying it directly to the principal makes a big dent. For example, a one-time payment of $12,500 applied to the principal on a 30-year mortgage would pay off the loan 2 years and 10 months early, saving nearly $79,000 in interest. And the more time remaining on the mortgage when that payment is made, the greater the savings. Making extra payments toward a mortgage comes with some powerful, tangible benefits. Peace of mind. Having no mortgage payment removes a significant financial burden. Cash flow freedom. That monthly payment becomes available for other goals, including investing. Lower debt to income ratio, which can improve credit and borrowing capacity. A paid off asset, ready for retirement or to pass on to future generations. What's the right call? It depends on the interest rate, the time horizon, and what brings more financial peace. Drop a comment below. It's always interesting to hear how different people approach this decision.